and we expect more to join as we go. But we have a packed schedule today, so I'm going to jump straight into the agenda. And before handing over to Lisa Poisson-Canton from GET.invest, who is generously supporting this webinar and the investment readiness tools you'll shortly hear more about, I'll go through the agenda. So after GET.invest speaks, I'll briefly discuss why we are producing these investment readiness tools to set the scene, and then dive into what these tools are. We'll then get the point of view of an investor, providing top tips on how to engage with them, and of a GDC member who has already been successful in raising external finance. As for the Q&A, as always, please drop your questions into the chat box, and one of the GDC team or of our guests will answer them directly as we go, or will take them during the Q&A slot at the end of the webinar. Today, you'll be hearing from Lisa Poisson-Canton, an advisor at GET.invest. It is GET.invest that is supporting this webinar. GET.invest is a European program which aims to mobilize investment in decentralized renewable energy supported by the European Union, Germany, Sweden, the Netherlands, and Austria. After that, we'll hear from Gabriel Landau, the founder and CEO of Charm Impact, that will provide an investor perspective of these investment readiness tools. And then we'll hear from David Wanjau, founder and CEO of Deevabits Green Energy of Kenya, providing the point of view of a last mile distributor. I'm now handing over to Lisa from GET.invest to tell us a bit more about the support they offer and how you as last mile distributors can access it. So over to you, Lisa.
Many thanks, Federico, and many thanks for your introductory words. Hello, everyone. I'm Lisa Poisson-Canton, and I'm an advisor at GET.invest. So I'm going to introduce you to GET.invest in a few words. Federico just named our donors. We are a European program that mobilizes investments, and it's being implemented by GIZ. The program is supported by the European Union, Germany, Sweden, the Netherlands, and Austria. So one of our core service is the GET.invest Finance Catalyst. The GET.invest Finance Catalyst links clean energy projects and companies with finance, targeting small and medium-scale renewable energy opportunities, currently in Sub-Saharan Africa, the Caribbean, and the Pacific region. So we have 25 experts in our pool, supporting around 135 active clients so far. So they offer investment strategy and structuring support, assist also in the identification of financing instruments, as well as with transaction advisory. So we have supported more than 295 projects, almost 300 projects and companies in the last 8 years, of which 58 have reached financial close. I see you moved to the next slide, which is perfect. It's highlighting some numbers of our Finance Catalyst results. We are constantly adapting to the technological developments in order to respond also to the new demands and orientations of funders and financiers, and to be able to provide the best possible support to project developers in the sector that is evolving extremely rapidly. So for example, on our website, you're gonna have the chance to have a look and see all the market segments we cover, pretty much everything eligible on renewable energy. From our extensive experience via the GET.invest Finance Catalyst, as well as consultations with relevant sector stakeholders, we have realized that early-stage locally owned and managed companies have special in-depth long-term advisory support needs to reach scale. This goes beyond what the Finance Catalyst does offer, specifically in enhancing capacities on accounting, financial controlling, setting up policies, operations, and processes. So we combine this targeted technical assistance with the tried and tested access to finance approach pioneered by the Finance Catalyst. Therefore, the GET.invest Finance Readiness Support, which is another service we offer, provides such technical advisory as well as access to finance support exclusively to locally owned and managed companies in our partner countries. So access to information is another important part of our work. I invite you all to visit our website, where you're also going to find a funding database where you can filter through all the different market segments, but also the different finance type and financiers we're working with, and our market insights if you want to learn a little bit more about the market highlights and challenges in some partner countries. This is all I can say in a very short time. Again, visit our website. You can write me also in the chat. I'm happy to answer all your questions. Many thanks for your attention, and back to you, Federico.
Yeah, thanks for that. And I know there are a few GDC members that are already benefiting from the services of GET.invest. So do get in touch, as Lisa just pointed out. Thanks for that. So now I will walk you through the tools which we're intending to assist early stage last mile distributors that want to begin their fundraising journey, and they're meant to pave the way to connect them with investors. Why did we decide to produce these tools? In previous investor forums that we've done, maybe you've participated in some of them, we have heard investors many times say that LMDs struggle to identify suitable investors and to communicate effectively. We've heard many times from investors that most of the applications they're receiving come from companies that are not well suited to them, that do not meet their basic eligibility criteria, whether it is the company development stage or the sector focus, or the geography, and other key pain points that they typically face are LMDs missing a strong pitch or missing a way to communicate their business effectively, what their value proposition is, what their strengths are, and so on. Problems with financial literacy as a number 2 key pain point, and number 3, having to go through a lot of effort to collect data from these companies in order to analyze them as an investment opportunity, to do their due diligence, and so on. We have, however, heard from these early stage funders that they're willing to be hands-on and support companies as they go through this process, but it is important that companies get into their radars in the first place. And the companies are sometimes struggling to do exactly that. And what we've heard from early stage GDC members is that it is too costly, too effort intensive to be investor ready. The administrative burden is too high, due diligence processes are too heavy, and negotiations are taking too long. So what we are doing or planning to do about this is, well, we can start with these investment readiness tools that we'll be talking about today, but we're also working on other activities to increase the visibility of last mile distributors. We are planning on starting a platform where companies can share information with investors in a way that's more streamlined and standardized. We're developing benchmarking tools so that companies can compare their performance with the average of the sector. And we are collaborating with investors to raise the visibility of last mile distribution, to identify challenges to investment, to work together on solutions, and ultimately increase the flow of capital into the sector. So these investment readiness tools, they're a set of simple tools for last mile distributors looking to begin their fundraising journey. And I'll stress begin, because these tools may not be as useful for our members who already have quite a bit of experience going through the process of raising external finance. These tools include an investment readiness self-assessment, the funder database, pitch recommendations and templates, and then other templates that investors will typically need as they analyze companies as investment opportunities. In particular, we are working on a financial model that is simple to use and will produce a lot of the financial information that these investors need. I'll go briefly through each of these, but we will not be covering them in detail during this webinar. For that, you'll need to go through the tools yourselves. These tools have already been uploaded in our Knowledge Hub. If they haven't, they'll be uploaded shortly, so feel free to download them and check them out after the webinar. A small caveat is that we are still tweaking our financial model slightly, so this may come in a couple of days later. We'll let you know when that is uploaded. So first, the investment readiness self-assessment. We want this tool to be useful for you to reflect on questions such as what do we need funding for? Which type of funding should we be looking for? Which type of funders should we target? And from these funders' perspective, are we ready for their investment? So what we need funding for is often related to the stage of development of the company. Companies that are at their proof of concept are typically getting off the ground. They have negligible revenues. And what they need funding for is to develop a prototype, for instance, or run a pilot to prove the concept of a business. Companies that are then working on their early operations are starting to make sales. They need external funding, on the one hand, to invest in minimal viable infrastructure, for example, a warehouse, vehicles for transport, hiring staff, and so on. And on the other, to grow sales. Then we have companies that are pursuing a fast growth trajectory. They have an ambition to become market leaders and operate across several markets. These companies need substantial capital to grow and for their operations. And then we have companies that are making sales and are getting to having a strong track record in terms of sales, but are rather on a moderate growth trajectory. But these companies still need funding for inventory, for receivables if they're providing consumer financing, but they may also need funding for optimization of their user base, their product offering, or to scale. So depending on these needs, different types of capital apply. We're using the terms pre-seed funding for that proof of concept stage. This is capital that typically comes from founders, family, friends, grants such as prize money, money from foundations, incubators, crowdfunders, and so on, and exceptionally equity from angel investors. Then seed funding for that early operation stage, where in addition to your own funds, you'll want external finance from grants, seed equity, or debt, for instance, for working capital, since you're already making sales at this stage. Companies pursuing that fast growth route will go through a formal Series A round and later rounds to raise substantial equity and debt. And those pursuing that moderate growth route, who are companies that many times are trying to retain ownership of their companies, will be looking for smaller amounts, but still consistent funding, primarily for working capital loans. There are different types of grants of equity and of debt that companies can access. And the tool provides explanations on the ones that you see on the right side of the screen that are listed from least onerous, which does not necessarily mean easy, like grants, all the way to most onerous, like equity, where companies have to go through this complex exercise of valuation. Once you've determined what type of funding you need, then which specific funders do you approach? In previous research that we've done at the GDC and have already presented, we mapped concrete investors with a track record in last mile distribution that are active at different stages of company growth, from seed funding to, pre-seed to seed, to that Series A, and so on. So that you can identify which ones are relevant depending on where you're at. And what you're seeing in front of you is just a visual representation of information that you can find in the GDC's last mile distribution funding database. This is the one. So this funding database provides an overview of funders, which can be filtered by sector, by geography, by type of finance, ticket size, and stage of company growth. This is the pre-seed, seed, early operations, and the concepts that I just discussed before. Once you've filtered and identified those that are relevant to you, you will want to see who these investors have invested in before. And if any of these previous investments are companies that are similar to yours. In that case, you can consider that a good indicator that this investor may be a good fit for you. And after you've identified them, please make sure that you start by looking at their website and check their eligibility criteria in detail to make sure that you meet that criteria and that you may be a good fit for them. Finally, as part of this self-assessment, we want to provide a tool to measure our investment readiness from the point of view of investors. And for these, we're recommending the framework that was developed by Village Capital. It's the Venture Investment Readiness and Awareness Levels, or VIRAL framework, which can help you measure how investment ready you are using the language of investors. This framework provides 9 levels that companies go through over their lifetime, all the way from establishing the founding team to then scaling up and reaching a point where investors can start seeing an exit. It also identifies a range of criteria, like your team, your product, your business model, and others. And as a company using this tool, what you do is assess your company against each of the criteria in the top row, and then find at what level you are, and therefore what type of capital you should be raising. There are apps that can help you do this. And the way it works is you'll start figuring out at what level you are in for each of these criteria. And your overall level will be the maximum level in which all these criteria are fulfilled. One of the apps that can help you do this is the one we're suggesting there, Abaca, and we provide a link for it in the toolkit that can help you go through this self-assessment yourself. So we've gone through this self-assessment and the funder database. The third tool that we are providing is pitch recommendations and templates. There we reflect on the questions of how do we attract the attention of funders, how we pitch our business, and how do we build relationship with funders. So in addition to providing that pitch template, we're providing general advice on approaching investors, like the ones you see in front of you, starting with do your research, quality over quantity of targets. You are much better off focusing on the 10 most relevant investors that you have found and putting an effort to tailor your materials and tailor your approach to them than identifying 100 and sending untailored materials about your company to all of them. The second is build an investor tracker to manage each of the relationships that you're establishing with these investors. The third, and for each, I remind you, you'll have more detailed tips when you go through the tools. But that third one would be get introduced to investors. If you can avoid a cold email, a cold phone call, it is much better. So look within your networks to find out who can make an introduction. It could be an existing investor in your company. It could be a supplier. It could be an industry association. So think about that. Then prepare a good pitch. Once you've got the attention of some investors, keep them engaged and updated. A lot of time can pass before they invest, so make sure they're still kept in the loop. And finally, repeat and iterate. It will take time for you to raise money, so this exercise needs to be consistently done and iterated on. In particular, with regards to the pitch template that we are providing, it's a deck that mirrors each of the dimensions of this viral framework that I discussed before. So it provides templates for slides that will allow you to describe your team, the problem and vision of your company, your value proposition, your product, business model, etc. And for each of them, you'll have tips, you'll have examples of slides that have already been done by successful LMDs, successful in terms of having raised investment. So I hope you find them useful. And remember, your pitch should be tailored for every investor that you're pitching to. Your ask should be clear, so make sure to clearly state how much money you're raising, what type of capital you're raising, and what you're intending on using that for. And then your pitch deck can be both a comprehensive pitch deck, like the template that we provide, or it can be a 1 or a 2-pager condensing all of that information of the comprehensive pitch deck. And I'm pasting 2 brilliant examples of 2 of our members, ATEC and Deevabits, that have managed to cram into a 1-page, but a visually attractive 1-page, all the aspects that investors would want to know at a glance about your business in order to be enticed to look into your more detailed materials. So next, once you have engaged investors, what data do you share with them? And this is what we're providing in our final tool. This is a list of documents that you'll want to share with your investors through your data room. And in particular, we are working on a financial model that you'll be able to use to calculate your unit economics and your financial projections, which are the first things that investors will want to know about your business. And what this list is, what types of documents you should have in your data room are those that are listed there. So in addition to the pitch, that will be one of them, in addition to the financial model, that is another one of these documents that you'll want to be sharing. You'll have to share company documents, starting with your registration certificates. If you have investors, investor agreements, a capitalization table, your board of director materials, if they're relevant for your company, like the board minute meetings, board consents and actions, your financials, including your profit and loss statements, your pro forma statements for next year, and the financial model, which for which we encourage you use the model that we're preparing for you. And then your business plan and marketing materials. So this will include the more comprehensive text of your business plan and the condensed form in the pitch document or the 1-pager that will go through your business, your operations, your expansion plan, your market overview, and so on. And then, well, other areas, intellectual property may not be relevant for every last mile distributor, or actually for very few. But if you do have patents, trademarks, an IP strategy, that's where you share it. For your operations, you'll want documents and agreements for your sales process, for supplier agreements. You'll want to describe your staff, your list of employees, their titles, their CVs, their salaries, and any other documents that you may see as being relevant. Loan agreements, for instance, insurances, etc. So what's next? And we're not intending for these tools to be a standalone effort. We want to continue improving on them. We want to develop new tools. So your feedback as users is extremely valuable. So let us know what you think. And we'll continue working with other partners and on this topic and finding out how we can be helpful in terms of investment readiness. So this was the overview. And before I hand over to Charm, to provide the investor perspective, I'm going to be launching a poll to find out how useful you think these tools that I've described will be for your business, and what other resources you see the GDC working on moving forward that can be interesting for you as last mile distributors. Can I have the poll, please? Thanks. So I'll give you a couple of minutes to answer both of these questions, and then I'll ask Gav to come in. So thanks for answering that. I'll ask my colleagues to close the poll, please. And now I'm inviting Term Impact, Gav, to provide top tips for establishing a relationship with investors. Over to you, Gav.
Thanks very much, Fede. Can you hear me okay?
Yeah, perfect, thanks.
Perfect. Okay, great. I think that was really, really interesting to see. And I would emphasize for everyone the value in going back through, especially on, I'm not sure what the slide was entitled, but the documents you'll be required to have. Very useful. And the more you can be prepared, the better. So I'll go through a quick overview of who we are and then some do's and don'ts, and then feel free to message me separately any questions or put them in the chat. So as a company, we are one of the few early stage debt investors in the industry. Our aim is to work with you as a company to a series of loans that range in size from 10K up to £350,000. We also offer some hedging options, but our aim is essentially to help companies develop a meaningful credit history to be able to meet the minimum investment requirements of later stage investors. So I think it's a really critical missing puzzle piece in the industry, where a lot of the no's you're going to hear or have heard probably already is you're too early, right? It's one of very, very frustrating. I get told that quite a lot as well when we're raising money too. And how do you not be too early if no one's willing to give you money? And so Charm's role is to be that people who aren't going to say you're too early. You will sometimes still be too early, but really understanding how can we help you develop a credit history in a commercial manner. How can we provide you a credit score that improves over your time? So let's whiz through the do's and don'ts. So the first do that I think is really, really important is understanding what money you need and why. So if you're coming to an equity investor and saying, we need equity so that we can get leverage to raise debt, as an example, I've heard that in the past, it's a really poor reason for me to give you equity, because you're not telling me how I'm going to improve my business, how I'm going to sell those shares over time, how I'm going to make more money investing now than when you sell the company in 5 years and have a clear exit plan. If you're telling me you need match funding for a grant and you can de-risk my debt because you know that you're going to receive a results-based finance drop of capital in a month's time after you lay out this capital, much more compelling proposition. So make sure you really understand the type of capital you need and why, and you can explain that. So, and it can be as simple as to say, I need capital to purchase inventory. My cash flows are doing really well. We should have enough inventory, and we can prove to you we have more demand than we do supply of product. If you can provide us a loan of X, we can purchase Y systems to make Z revenue from this many new sales. That moves us on to number 2, which is sounds elementary. I think you're going to hear it a lot, is understand your unit economics and your financials. My key point here on the do, and it blurs a bit into a don't, is being comfortable as the leader of your organization to understand your financials. You don't need to be the expert. You need to understand them enough, and you need to not underestimate the value of them, especially if you're providing pay-go services. We're going to want to understand as an investor, what's your credit policy? How do you choose your customers? How do you select them? And if you don't understand that, how can we trust you to use the money to sell to the right people who will then pay you back so you can pay us back? So don't be afraid of your financials. That's my don't to go with the do, right? You need to really engage with them and understand them enough to be able to do that. And if you feel like it's a weakness of you personally, still don't shy away from it, but bring your financial expert onto the calls with those investors and don't go it alone. Goes on to the third point, show the strengths of your team. Okay, understand who you are, how you operate, and why you have some advantage in the market. But don't just give me a box that says my competitors all have red X's and we've got 5 green ticks and they've got 5 red X's. I want to understand the nuance and the subtlety of, like, why is your team strong? What have you done so far with the limited resources you have? And how will an injection of capital mean you can capitalize on your strengths to go further? Next, be honest about where you need to improve. Okay, at the stage of investment we do especially, which is pretty early, so we look at post proof of concept, post revenue, but still early. You shouldn't be doing R&D anymore when you're taking on a loan. But be honest, we need to improve X, Y, Z. Now, does that pose a risk to the loan? Maybe, but it's better that you tell us that you are aware of areas of your business you need to improve up front and tell us how you're going to improve them, rather than we find them out and ask you questions and it seems like you're hiding something or anything else. The final point I'd say on the do's is really spend the time to research the investors and understand what they're looking for. Now, there's two parts here. The first one is the investors need you as well as you need the investor. It doesn't always feel that way. It often feels like there's a power imbalance. But realistically, if I look at Charm, we make money when we deploy a loan. We can only deploy a loan if we have companies to give a loan to. So we need you just as much as you need us. And there is a synergistic relationship there. And if you have an investor over pushing their power in this relationship, it's probably not the right investor for you. And you might not have an option around which investors you work with. I appreciate that. But understand what they're looking for and remember it's a two-way street. The second part on research the investor I want to emphasize is if you're pitching to an investor who's already part of the industry, they don't necessarily need to know the same stats around the number of people that aren't electrified or how big the gap is of how many people don't have clean cooking and why it's so important, because they should know that already. And so what I want to know is the difference. Why is clean cooking as a sector? I already know about that. But what's your advantage of clean cooking in your specific market, in your specific region, that gives me something to understand you within the context of the sector that I'm already knowledgeable of? Don't give me just generic high-level information, because otherwise, if we look across the GDC, you'll have like 5 slides that are the same pitch deck, right? How big is the problem? How big is it scalable? But that's not really what you're going to solve. So I'd really hone in on who's the investor. If they already know stuff about the industry, give them more, show them you understand those nuances. On the don'ts, and some of these you might think I'd never do that. We get it all the time, all of these. So please listen up, because they're the worst things we've heard. Okay, don't miss meetings or calls ever. And if you do, miss them once, don't do it more than once, and give a reason and send a note. Okay, often we find, especially with last mile distribution and companies really hustling, you're in the field, you're selling. Don't underestimate that missing a meeting shows us how much you value our relationship or how much you don't value our relationship. And additionally, if we're thinking of how to manage a relationship for the long term, what does that say about our relationship and how easy it's going to be to manage them? Missing meetings and calls is really bad. Okay, even if you're in the field, even if you've got bad signal, you know the call is coming, it's in your diary. Try not to do it once at most. It sets a really bad tone and a bad precedent, and it makes us not want to work with you. The next part of that goes with keep quiet, and even if you're in the field, is don't forget that raising money is hard and it takes a long time and it's taking you away from what you want to be doing, which is operational excellence. But to an extent, my a bit mean view is tough. Right? If you don't have the money to grow the business, it doesn't matter how great you are in the field, you'll never get there. So really think about those priorities. Keep quiet, don't do it. So let's say, and we get this quite a lot, we ask for audited accounts and you tell us our accounts are going to be audited by the end of November and we'll get back to you. But you don't get back to us. I would rather you tell me our audits are taking longer than they should. We should have them by mid-December. I'll give you an update in the first week of December, and then follow through with that. Or we make a data request, you just don't have the data. And rather than telling us we don't have that right now, you just stay silent. Silence is really bad, because even if you're not a good input fit right now, we're not going to want to come back to you, because last time you ghosted us, you disappeared for 6 months, and then you came back knocking on the door and said, we've got those things you asked for now. Can we have some money? Can we re-engage this conversation? And our response is going to be very tempered, because we don't want to work with people who suddenly go silent and don't respect those relationships. And it works both ways, right? If we suddenly went silent for periods on end, you shouldn't want to work with us either. We try our best not to. Okay, so those are really my two top ones. The next three are a bit weaker, but just things to bear in mind, and often we see them. Don't partially submit required information. Make sure you fully submit everything that's asked of you. And it goes back to the last point. If it takes a bit of time to get the next point, just tell us, hey, you've asked for X, it'll take us a period of time, we'll get it back to you by this date, and stick to your date, and tell us if you're going to miss the date. But don't just submit some documents and say, yep, we're all done. All it does is leave a sour taste in the mouth. We have to follow up with you. It makes the process take longer. It becomes more arduous. You knew they were asked up front, meet the requirements. Don't oversell yourselves. It's a really tempting thing to do because we see a lot of companies making really grandiose statements of how they can do so much and what they're going to achieve. Might be appropriate for an equity play because you want to see the future. It depends. For us, especially as a loan, as debt investors, we want to see reality. We want to see meaningful projections that show us you understand your business, you understand how your business can grow, and it doesn't just have ridiculous projections, because then we question both your integrity and your understanding of the business. And if we can't understand that, it all feeds together, right? So be realistic and ambitious, but don't oversell. The final one that I see a lot more recently, this is a new item I added to my list. There's lots of technical assistance support out there, but I don't really want to talk to a consultant about why your business is so great. I want to talk to you. I want to understand how you understand your business, and it's not something I would outsource. Outsource the introduction, outsource helping you review your pitch deck, outsource anything that takes a long time like that. When you're getting to talking to the people who are going to hopefully invest in you, I want to see you. I want to see, again, you value that relationship. You want to take that time and that you understand your business. Putting a consultant in front of us first, it gives us questions why. Do you not understand your business well enough? Do you not have the confidence to pitch? I don't know. But really, I want to understand you, and we're never going to invest just by speaking through consultants, and I would cut them out where you can at the right stage. Hope that's not treading on anyone else's toes in this call, but get them through the door, and then you should be leading the sale for yourself.
Thanks. Yeah, thanks a lot, Gav. That was brilliant. And that echoes a lot of the advice that LMDs will find in the slides, but I think it's much better to see that advice come to life and hear directly from an investor. So thanks a lot for that. And so next, I'd like to call David from Deevabits, an LMD that succeeded in raising finance and has recommendations for those that are actively looking to fundraise. Over to you, David.
Thank you so much, Federico. And I think this was a very interesting session, actually. And I feel Gav has covered a lot of stuff that probably would have been good for me to also share. But I think I might put it in different lights, but I think we're almost heading the same direction. But just to introduce, Deevabits is a for-profit social enterprise based in Kenya. We are in energy access industry, and our key role is actually to distribute and financing solar products in these rural communities, especially off-grid ones. And we work with a community of village social entrepreneurs, creating jobs in these rural communities where there are very few economic opportunities. So we've been in operation for the last 6 years, and we have grown from 2 counties to now 12 counties. So we have we have had our tough journey, especially in the fundraising journey, and I feel that I feel honored to be presenting the do's and the don'ts, especially in this journey. And there is a lot that entrepreneurs or last mile distributors do right and do wrong most of the times. And I'll start with some of the best do's that you can do in this journey. One, and I've put it in very different language, it's building social capital, but it's so deep. What we mean here, it's, you remember that a lot of investors are actually not just looking for good ideas, but they're also investing in good people. I think almost Gav was actually mentioning some, some concept into this. So if you're missing meetings, if you're not available, you're not building that kind of like good relationship with investors, no matter how good your idea is or your business, you will have a very tough journey in the fundraising. So when you're building social capital, you have to be real, be genuine, be authentic, and make these meaningful connections everywhere you go. And sometimes I see people trying to oversell their companies, and so they give wrong figures, they give wrong impressions. And remember what, 1 year down the line or 2 years down the line, you will face the similar investors. And what I've seen even in my journey is that I have interacted with investors who have changed jobs. So you find that you were dealing with so-and-so when they were working with a certain investment firm. 1 year down the line or 2 years down the line, they are now in a new investment firm. And if you never built a very good relationship with them, then it becomes very hard for you to go back there to this new organization and start selling your business. So make those meaningful connections. You're going to need them a lot. Seek support. I think there is a lot of organizations, experts who would serve as advisors and mentors who can really support your company. Don't just try to do it alone. And the good thing is, I think we have even a lot of, kind of like these services offered at free or at no cost by a lot of organizations, the likes of GDC and others. But you can only benefit if you're seeking this support and this kind of like services. So, build that social capital because it's very powerful for you in your journey. Then the other component is being prepared and over-prepared in this case. And I think this one, Federico and Gav has also mentioned. So you got to know your business very well. Nobody else knows your business better than the founders most of the times, So you have to know, what is the vision of the business? What's the mission? What are the key problems you're solving? And what is the long-term vision of this company? What are the goals? What are the challenges that as a company you're going through? And what KPIs or numbers can you actually talk about? What are your top lines? Revenues. Even bottom line. Are you breaking even? Are you profitable? How many people do you have in your organization? So some of these conversations are very require you to actually be very prepared with these numbers, especially when you're talking to investors. And that requires you to be investor ready. So this is a really interesting journey, especially when you start having all these materials ready, numbers ready, and know your product, and understand the wins and the downs of your business model, because you won't be 100% perfect. So the other component is, and I think this one, was Federico has also mentioned, is that investors, would, work with somebody that has been referred to them easily than when you just reach out through a cold call or a cold email. So, and this is the reality, I think, even in our friendship zone. So even in investment zones, you have to use warm introductions. And this also comes in line with what I was talking about, building social capital. Because if you're making meaningful connections wherever you go, then you have people or a network of people that can make introductions, And of course, even if you want to work with your contacts to secure introduction, but all your contacts you don't have meaningful connections, then it will be very challenging for you, to get introductions. Because an introduction is a vote of confidence in a way. So when I'm recommending you, if you go and disappoint us, then even my reputation is tainted. So therefore, I have to have confidence that whoever I'm referring to or recommending is a good guy or a good, person, a good entrepreneur, and they have a solid business. So therefore, our connection has to be very powerful. So the don'ts I've just used a few of them that are very critical. And one that is typical, and even us as a company, we have grown through the same program and tried to perfect it over time, is that a lot of time entrepreneurs or last mile distributors, we are busy working in our business. We are trying to get the next sale. We are trying to find sales agents. We are trying to figure out installations in the field, and that actually ends up missing out even important meetings with investors, as Gav is mentioning. But also you forget to accompany it where you have to work on your business. And when I mean working on your business is when you start looking at what is needed by your company to succeed. What kind of tools, support, investment, who do you need to talk to, what documentation do you need to develop to make sure that you can attract investment. And raising funds is a really, really tough journey, especially here in Africa. And sometimes, before I actually came to a point whereby, I had to focus a lot on building on the business. It was really tough, because you're busy in the field and you try to figure out where to get the next cash, to buy stock and inventory. And yes, you're not building some of these tools or preparing documentation that is needed by investors. So you have to have a pause and create systems that you can actually, their operations can operate without you in the field, and start focusing on building on your business, which is very important. The other one, I think, which one has been mentioned a lot, talking to the wrong investors. So this one is investors have different scopes. Probably they want to invest in a different industry. They're interested in a different geography. Sometimes you find investors who actually meet all your criteria, but they're probably not investing in your country. So even if you approach them or you got introductions, maybe can help in a future one, but it probably might be a wrong approach if you had narrowed down your research. And the new tools that GTC have, where you can filter out investors in your industry and geography and the ticket sizes, really helps. And I think there are a lot of tools like that recently. So use that and create a way to narrow down to a few investors that really meet your criteria. The last point, which I would really want to emphasize, is understating your funding need. Most of the times, we are trying to play safe. We think that probably a smaller ticket, it's easy to get funding, which might be true, but you can get funding that there is not sufficient. Like, you have to think about, in the next 12 months, do I have enough, cash? What's your burn rate? How far can you run with the cash that you have or the cash you're raising? Because the big problem sometimes raising small cash than your business really needs is that also, new capital can come with a few covenants that can prevent you from accessing even immediate extra capital before you meet certain covenants. And therefore, the insufficient funds might even lead to you running out of cash. And when you don't have cash to operate, your business will actually fail. So it's always very good to actually really look at financial model and really understand unit economics. Do a proper planning for your cash needs. Then start raising up that cash. And for example, you might find investors that might not be able to fund 100%, but they really know that, hey, you're looking for $500,000, but our organization as an investor, we can only, give you $200,000, and therefore becomes easy for you to also get introductions to other investors that might be addressing the gap, rather than just fundraising $200,000, but your business actually needs $500,000. So I think I'll stop there because of time. But I think I have shared a little bit of good points that last mile distributors are probably going through, and hope that you become better than we've been before. Thank you.
Thanks a lot, David. All very useful advice. And there are more materials of Deevabits in the toolkit. The story that they've gone through and some of the materials they've used to raise funding before. It's So I hope you find that useful as well. And now is the time for the Q&A. We don't have a lot of questions in the chat. There's one from Richard that I'll address in a minute, but feel free to raise your hands or put more questions in the chat, and I'll call you. But before doing that, maybe a couple of questions from myself, starting with one for David. I was wondering if you could tell us maybe who was your first external investor in the company, how that went, what you valued most about them, how much it was, something briefly about how you started, the very start of your fundraising journey.
Oh, thank you. Yeah. So first external investment was in form of grant, actually, and we had applied for the Deep Prize Award. So that was the first time we got some external funding, which was $10,000 to pilot. Initially, we were playing a lot of or seeking a lot of opportunities for competitions or call for applications. And after Deep Prize, we also won the Power Africa Off-Grid Challenge, where we got $100,000, and that was a really significant one because it enabled us to actually pilot our model in a bigger scale. And with that, we were able to prove that our business model can work in rural areas and can be profitable. And with that, we were able now to start attracting debt investments. And the first debt was from Kiva, which was $50,000 in debt. And from there, we've been growing because as we were preparing for Kiva, especially the due diligence process, we started documenting our data room. So it also became easier for our next investment, which came from Sima and Gaza Distributor Finance Fund. So, and we kept getting more funds, and we've been growing. And I think recently, we have accumulated a lot of debt capital from different investors, including Social Business. We have gotten more top-up loans from Kiva, from beneficial returns, and current and also from Energy Access Relief Fund. So we've been very fortunate with the debt raise, and now we are working on an equity raise. So kind of like the fundraising journey continues.
Thanks for that, and good luck with the continuation of the fundraising journey. Then I have a question for Gav, but you can also chip in if you want, David. But we've been discussing about this importance of tapping into your network to get introductions to funders, but there's quite a few of our members that are beginning their journey, may not have very well developed networks, at least not internationally, and not be able to find a way into these networks. Just wondering if you have a suggestion on whether they should cold email, cold call investors directly, or should they spend more time developing their networks in order to get to them? So Gav, I was wondering if you have any suggestions or wisdom for those that would cold email you. That'd be good for a lot of our members, I think.
Sure, no, great question, Fede. I'll give you two answers, okay? So first answer is it depends on the investor. Okay, so for us, I don't mind cold emails, it's fine by me, but that's our mandate, right? We want to be working with early stage younger companies. Our mission is all about financial exclusion. The need to have a network to be able to get access investors is a reason financial exclusion exists. So we don't have that policy, but it does exist in quite a lot of places. So like foundations, for example, are very network based. So you have to try and find your low-hanging fruit. It won't always be obvious. I would say try. I would say try and get the intros, but also, just have a look on LinkedIn, see who they've invested with, and be smart about it. So like you see, we've invested, you might think I might not reply to you directly, go through one of our investees. and say, oh, I can see you've had a loan from Charm before. Can you give us an intro? You know, so you can be smart about the way in which you do it. But for me personally, at least at Charm, I would say we're very open to cold contact. We'd love to know more about you. It definitely helps, but like, we want you to come to us. It's a good thing for us. The second part, I just give a quick personal one, Fede. Our first bit of funding was from a cold email. So on an organization who said we don't accept cold emails. So it can work. You have to be a bit of luck, a bit of timing, and you have to write a good email that piques their curiosity. Generally, it's going to be that you're saying something in your email that is solving a problem that they are looking to solve right then and there. So it has to be coincidental. Timing is a bit luck, but it's been successful for us. So I'd say don't hold back for that. But yes, if you can get an intro, helpful, but I wouldn't say do it with don't wait, basically.
Thanks a lot. That's useful. Then I have a question, or the first question that was posted in the chat is from Richard, and he's asking about reaching out to investors that are not active in the regions in which they operate. I'm not sure which region Richard is in, but he's suggesting that the GDC can play a role into, if I understand correctly, maybe bring investors into areas that may have a gap in investment. And this is something that we have considered, but just wondering, and this would be for Gav again, if there's any role you think we have to play there, if we, in our market intelligence research, detect areas that are very much underserved in terms of access to finance, can we get the attention of investors to consider moving into those areas?
Probably not. I would say the reality for anyone applying for funding, and this is where the research bit comes in, you're not going to get them to change their mandate. And to think you are is very naive. I've tried a lot of times for us. Okay, so we get hit the same thing, right? We're too small. We don't hit the minimum investment. We're in the wrong markets. We might have the wrong product. Our risk profile's off. It's very difficult, and you're going to find it really challenging to get them to change their mandate for you. And so that's where I think the research comes in. If you're at a loose end, fine, go for it. There's nothing to lose, but the likelihood of success is going to be much lower. I think it's helpful to signpost where people are actively investing as a role the GDC could play. But I do think it's harder, like that's useful to know these investors invest in these markets. So I can see someone saying, do you invest in Tanzania? As an example, we do, but we might not be investing in Chad right now. I don't know.
Got it.
But that is fluid as well. So yeah, I don't know if that helps.
Yeah, no, it helps. So thanks for that. And to reach out, I would say, look for investors that are active in your area. Our database should help for that. And otherwise, let us know, and we'll see what we can do in terms of producing market intelligence and trying to sway certain investors. But now, unfortunately, we're out of time. There are questions that are left in the box that we'll try to address offline. Thanks for posting them, and thanks a lot for joining today. We hope you found it useful. We'll share the recording, we'll share the slides and the links to the tools and templates in the next few days. And we'd like to throw a final poll to ask whether you thought this was useful and any other recommendations you may have. So please, if my colleagues can launch the poll, and I'll say that this was the last GDC webinar of this year, but we'll be back in the new year with more webinars, kicking off with a Cook Stoves trade show. So stay tuned for more details and to register, and let us know if there are particular topics that you'd like to dive into. So thanks a lot again, and see you soon, hopefully. Goodbye.